holding companies come in just many, many, many different kinds of shapes and sizes and textures. I mean, let me sort of reject a few that are never going to be of interest to me. For example, again, holding companies all have their own histories, which would, to some degree influences and determines their purpose. So for example, a holding company that exists for the pure sole purpose of exerting control of another entity or collection of entities, for the sole purpose of that and nothing else, is of no interest to me. Example of that, I'm not saying it's a good or bad thing, is Peugeot's holding company, PSA. And it's always been a discount. I think Peugeot is not a brilliantly managed company, and it shows. And all you do is buy Peugeot shares, and the discount narrows, the discount widens, and whatever it is. I mean, that's of no interest to me. It's always a discount. So mechanically, it's a discount. Second, holding companies where there's control exerted, it's very important from my perspective to see the nature of control that's exerted. So for example, during the early stages of the global financial crisis, 2008, when Europe was beginning to get hit in early mid-2008, we bought a Swedish holding company called Lundbergs, which we don't own anymore. Lundbergs is a family that controlled this collection of different investments, focused largely on real estate and financial services, and some of the metal bender, the standard Swedish industrial companies. Again, here was a situation where the family had A-B shares. There's two-class share structure that control this company through the class of super voting shares. So you have to be super cautious there as to what their motivations are. How are they running the companies? And you have to be brutally honest with yourself and critical in terms of the nature of the engagement of each of these own holdings that they have and how they've added value over time. And to our mind, they've done a very, very good job. Hence, that Swedish holding company got into our portfolio because of that. For example, Handelsbanken. Handelsbanken, which is one of the banks over which they exert a certain degree of influence. Handelsbanken was the only Swedish bank which did not have to go through a recapitalization. All the other ones did, be it Nordea, Swedbank, and SEB, Svenska Banken, all of them. And the SEB is controlled by the Wallenberg family. So watchfulness in terms of control in a constructive way is an important thing. So that's another aspect. Are they adding value? Or are they using, so that's very important. Third factor is, in terms of holding costs. What does it cost to run this business? We don't want yet another layer of cost. Oftentimes, holding companies are a very efficient way to own a cluster of assets which are managed cheaply. Think compared to a mutual fund, for example, and is it compelling? Is it 0.2% of assets that they're managing and overseeing? So that kind of stuff. So this is exerting yet another layer of cost? Ideally not. Fourth, what's of importance to you, it should be, are the assets inside it cheap and are they interesting to own? So that's getting to the core of what it is you're really trying to do with owning a holding company. So you have cheap assets sitting inside. You have on top of that a further discount, holding company discount, reflecting, hopefully it's a big one, these are cheap, and hopefully it's a big discount to boot. And of course, therefore, you're getting a double sort of, if I think of it as a leveraged way of owning investments. So, those things go up in value, the NAV increases, and the discount shrinks. That's another aspect to it. Now, what I do not like is the mechanically looking at discounts. Okay, this is a 40% discount, therefore it's better than this 24% discount. The stuff that could be contained in the company at 40% discount could be expensive stuff. Whereas the one that is at a 24% discount could own severely depressed securities. So clearly, the one at 24%, so you don't blindly follow discounts. You want to have to own the stuff sitting inside it, and this is another layer of discount. Obviously, governance that you alluded to is a very important thing. It's very, very, very important. And also an important thing is in terms of thinking. I'd like you to think about what a corporate, you have to think, there are two sets of thoughts you have to think through. The underlying corporate entities, are they of interest to you? And the sort of overlay of the holder, the owner, the control party. Is their orientation aligned with yours? So are there communities of interest, or are they going to rip you off? Are they going to screw you? You have to worry about it. You worry about that at the level of the companies, you have to worry about that additionally at the level of the control parties. So the usual paranoia applies. And there's one last thing. So And this is something really, really highlighted by the global financial crisis. So there's a collection of holding companies, and in those days, a number of them were in France, still are, that used to do sort of private equity type investing. And there's a bunch of those. I mean, there's all kinds of holding companies out there in this world. So the argument that they would lay out is, we're doing these buyouts, we own equity in these companies, which we control, we oversee them, and the leverage is at the operating company, and we upstairs, the holding company, have a clean balance sheet, or cashed up balance sheet. So we have no net debt. They would tell you that. So all true, all factual, and the debt at the level of the operating company is non-recourse to the holding company. Also true, very good. And of course, the debt is at the operating company, so there's a matching of cash inflow and cash outflow to support the debt. All good. So what's wrong with this picture? Well, what's wrong with this picture is the following. You own these leverage companies. You, Mr. Holding Company, own the leverage companies, and the problem is the global financial crisis did some nasty stuff to some of the businesses. Leveraged businesses found they couldn't refinance stuff. Leveraged businesses found that they weren't making much money, and that made it even harder for them to service their debt. So effectively, what was non-recourse, the gun to the holding company's head was, if you don't stick in equity capital, you are going to lose all your equity in this business. So was it really non-recourse? Yes, in name it was non-recourse. Operation, it was very much recourse. So you have to separate the leveraging. So in general, we do not like A, leverage of the holding company, and B, we do not like a lot of leveraging down below either. We do not like too much leveraging going on down below either. So that is very important for us. So that's sort of how we think of holding companies.